Hello friends. In the week gone by, we saw the markets spring back to action on Friday. The Indian markets rose spectacularly on Friday and the US markets were breathtaking in their rally. The bulls seem to have fought the bears and are making their intent of getting the markets a bit higher. Will they go through with follow-up action? Will the markets bounce back from here? And is the rally sustainable? This video is going to be all about that. I'm Vijay Bhambwani and I've been trading these markets since 1986. Through my videos, I want to help my friends take better trading and investment decisions. Last week, I said that the rally is nothing but a pullback rally and not a trend reversal. That played out pretty well and the markets saw selling pressure at higher levels. I've been putting up all that stuff on my social media accounts on a day-on-day basis, so please feel free to connect with me and update yourself. And Thursday was a noticeable trend-forming day because the bulls started sowing the seeds of fighting back in the latter half of the session on Thursday itself. And Friday, which I keep on telling you on my social media posts to watch the trading action in the last 75 minutes of trade. And I've also explained to you why, because the seeds of Monday's open are planted in the last 75 minutes of trade on Friday. So if Friday's activity is anything to go by, it looks like the bulls are going to spring back to action, at least on open on Monday. Now, is this up move sustainable? Will the bulls grab the initiative again and take the markets higher? We're going to see that in the next few minutes. So coming up on your screen is the market roundup window, which tells you that it was the bank Nifty which fell more than the Nifty 50, expectedly so, because there were worries of inflation. There were worries of the US dollar hitting a new high versus the Indian rupee. And risk-on sentiments prevailed, which is why, in spite of all that volatility, you saw gold and silver easing a bit. Of course, a rising US dollar index, or the Dixie, had a lot more role to play. And mercifully, we saw crude oil prices coming down almost 6%, which is always good because crude is an inflationary commodity and it has a multiplier effect across the board. Now, the USD INR closed at 79.93 in the currency derivative segment in the prompt month futures after kissing 80 plus levels. Now, this is a slight concern for the market, and the fact that the Indian forex reserves are now marginally below $600 billion are at a one-year low might just be a slight concern for the USD INR. Bond yields rose a bit to 7.42. That's also a marginal concern, and that reflected in the weakness in the bank Nifty. MWPL continued to rise, which is natural after the expiry and right up to the third week of the derivative cycle. So that was in play here. NSE gained 0.14% in market capitalization, which is neither here nor there. It just about managed to stay up. The US market indices, in spite of the spectacular rally on Friday, were still in the red. And the S&P 500, the broadest of the three indices that I'm covering here, remained a little under 1% below water. Now, coming to the daily chart of the US Dow Jones Industrial Average, we are seeing that the death cross, where the 50-day moving average is below the 200-day average, still remains in place. The price has still not gone above even the 50-day moving average. So, if at all there is a pullback coming, it is still a technical bounce and not a complete trend reversal, at least in the US markets. We are going to take the Indian markets as we come to the Nifty and Bank Nifty. Now, when the Nasdaq 100 is concerned, here again, the death cross remains in place. The price is making higher bottoms but not necessarily higher tops. So a bullish triangle is forming on the daily chart, but we need a breakout above a round number before we can say that the Nasdaq 100 index is showing signs of a trend reversal. In any case, in both these indices, we have still not seen a previous swing high being taken out. That would be the first step towards saying that a bull market has started. You must overcome at least one previous swing high. Now let's see the S&P 500. Here again, you are seeing a death cross in place. The 50-day average remains below the 200-day average. So what you are seeing is at best a technical pullback rally occurring. Not even one significant previous swing high has been overcome yet. Coming now to our in-house indicators, I start with the MWPL or the market-wide position limits. Now these are limits that the traders have actually utilized as compared to the limits that are allowed by SEBI. We are now at 26.11% on Friday. Now that tells you that even the round number of 30% MWPL is very likely to remain elusive. As a matter of fact, as we head towards expiry, it would be a very, very positive factor. And the first, one of the first prerequisites that I would look at is to go above 30%, because we've not gone above 30% for 20 weeks. And the 35% high that was made in November has never been scaled thereafter. So the two Marshmallow bulls need to show high degree of aggression by taking the MWPL first above 30% and then possibly even above 32, 33, 34%. Let's now take the futures turnover in both the indices and individual stocks. These are cumulative three expiries, so it's July, August, and September. Even though the index turnover is at almost a 20-week low, it has risen from the abysmal turnover that was logged last week. Now that's the blue line. The stock futures turnover has also risen a tad. Now this is one of the first and the earliest indicators that the bulls are attempting. I'm using the word attempting, not succeeding. The bulls are attempting to fight back. And we need to see follow-up action before we can basically go out there and write out a check. Now I'm coming to the basis chart. Now basis is a two Marshmallow risk appetite. All right. Basis is nothing but the future or the premium or the discount enjoyed by futures over the spot. Mercifully, both these indices, the Nifty 50 and the Bank Nifty, have seen basis expansion, which means the premium has risen over spot. What does that tell you? That tells you that traders are willing to pay a higher premium to go long on the Nifty and the Bank Nifty in spite of the fact that there is one less week remaining to expiry. Normally, just like your option premium, the futures premium also tends to come down as you head towards expiry. But here, the premium has gone up. A, it could be short covering, and B, it's also fresh buying coming in. So early days yet, but this is another sign that the bulls are trying to get back. The most leading indicator of market trend reversals after the price itself is, in my humble opinion, the NSE advanced decline ratio, the number of shares advancing versus the number of shares falling. If at all you want a bull market to succeed, you want the price and the NSE advanced decline ratio to go up together. Now, this is the fourth consecutive week where the ratio has remained above 1:1. Admittedly, for the past 3 weeks, it's not really been very high, but it's not going below 1 either. So the number of gainers, this is a line chart connecting levels from one Friday to the next. So we are not seeing the bulls give up as yet. And if this ratio starts to climb and stay above 1.5, 1.8 or even 2, this could be the first indicator that the bulls are actually charging ahead. Where do you get this data? On my social media account. I update this stuff every day, end of the day, late evening. So please feel free to connect with me. My contact coordinates come at the fag end of this video. For our in-house exclusive indicator, the impetus, which you've trusted for more than a year and a half now. Last week, we saw both the indices, the Nifty and the Bank Nifty, lose ground. They were both in the negative, the Bank Nifty more than the Nifty 50, but what you are seeing is that the impetus for both these indices has fallen, which means that the selling lacked force. Had the selling been forceful, both the impetus readings for the Nifty and the Bank Nifty would have been higher. So just like no bad news is good news, lack of impetus on selling is also quasi or indirect good news, which means the bears are backing off from pressurizing at lower levels a bit too much. Now, for the LWTD, the lift, weight, thrust, drag indicator, the tutorials to all these videos, the Marshmallow theory, LWTD, etc. are in the description and in the pinned comment below this video. Don't get intimidated by this. What we are seeing is the Nifty percentage gain loss line, indicated as a blue line, has closed above zero for the second consecutive week. And the LWTD has remained below zero for the second consecutive week, but it's inched a little higher even in the negative territory. It tells you that week on week, the bulls seem to be showing a little more inclination to support the markets at lower levels. Like the impetus reading before this is showing that the selling momentum may be easing a little bit, which by itself is good news, provided the bulls come back in the coming week and start supporting the markets very aggressively. We need risk appetite to go up. Now I come to the footprint of the four market participants in the markets. I start with the FIIs, where their individual stock futures net long positions are concerned. They've gone down a bit and their index short positions have increased. So the FIIs have taken a very, very cautious approach, at least in the futures exposure. Where DIIs are concerned, where the indices are concerned, they've cut their net short positions aggressively. They still remain net short though. Whereas where their individual stock futures shorts are concerned, they've also cut them marginally. It's not much, but the figure still shows the shorts are mildly lesser. So they seem to be taking a little more optimistic approach as compared to the FIIs. Now for the prop traders. Now this is interesting because these are brokers. They know who's buying and selling, and therefore they are second best to insiders. These are brokers' own proprietary trades. Where the index futures are concerned, they've never been this bearish in 20 weeks. That is how long the data is for. They are net short, and these shorts are the highest in 20 weeks, whereas their individual stock futures long positions have crept up by something like 3,700 odd lots approximately. So they seem to be taking a balanced approach. Go long in individual stocks, go short in the index. Now that's like taking a neutral approach. So they are proceeding cautiously. Let's now take the retail traders. These guys have been doing all the heavy lifting since the rally started in late March 2020. The sheer magnitude and the quantum of their buying and selling, because they're holding such long positions, can impact the markets. What they've done is increase their net long positions in the index futures and ditto for individual stock futures. Their individual stock futures net long positions had fallen below the 1 million mark last week, but it's back above a million. Now, this is telling you that the prop guys seem to be cautious. They're going long on individual stocks. The retail guys are going long on individual stocks. Prop is shorting the index, but retail guys are buying the index futures as well. This market is increasingly becoming a tug of war between the FIIs and DIIs and the prop and retail on the other end of the spectrum. Friends, the indicators done. I now come to the bond market, a very critical aspect of the market. I've been telling you since years, you will ignore the bond market at your own risk. We saw the India 10-year benchmark bond yield creep up by 2 basis points. That tells you that bond prices have fallen a little bit. What does it tell you? As we head towards the RBI's Monetary Policy Committee meeting in August, which will decide on interest rates, the bond market, seems to indicate that number one, inflation will go high. Number two, possibly the RBI Monetary Policy Committee meeting or MPC meeting might raise interest rates. The fact that many countries across the world, and I've been posting this actively on my social media accounts, are raising interest rate will force the RBI to think on the cash carry trade. What is the cash carry trade? If India is offering 7.5% on its bond yield, or say a fixed deposit of 6% hypothetically, and country XYZ is offering 10%, cash carry trade says all other factors remaining constant, money will fly out of India because India is offering 6% and go into a country which is offering 10%. This is the cash carry trade. So to basically keep the FII money which is invested in India within India and possibly attract even more money, the RBI Monetary Policy Committee might be forced to step up the coupon rates in the forthcoming meeting. Early days yet, we are just conjecturing. If interest rates are hiked, that much more pressure on interest rate sensitives. I've been keeping in touch with you very, very proactively on my Telegram account. I've been telling you on my Telegram channel as to why interest rate sensitive stocks, companies which are very heavily dependent on EMI based sales of their products, may be impacted negatively. So be actively aware. Monitor my posts on the Telegram channel. How to contact me and connect with me is all there in the description and in the pinned comment below. So if the bond yield was to go above 7.50 and stay there, that could pressurize the bank Nifty significantly in the coming week. So do make a note of that. And I stick my neck out and maintain my view that I put in a fortnight ago that the 7.20 level remains like a Maginot line, a very, very strongly defended yield threshold, which is unlikely to breach. Even if it does, I'll be surprised if it does. I think it could be more of a photo opportunity where the yields kiss that distance and then spring back again. So cost of funds will rise and that could pressurize equity markets and other risk assets. This is something that you need to keep in mind. India being a net importer, all imported goods become more expensive and therefore we are importing inflation, which is a direct bearing on bond yields. So if the USD INR was to go above 80 again and stay above 80 and bond yields are going above 7.50 and staying above that level, I think banking stocks might just come under pressure and you could sweat under the collar a little more. Do monitor this aspect, please. Bond yields done. I now come to the US dollar index, the Dixie. Do remember, India is a net importer since independence, and any and everything that we import becomes more expensive if the dollar is strong vis-a-vis the rupee. Now, what we saw is the Dixie on a week-on-week basis gained 1.02%. It rose on 3 out of 5 trading sessions in the week gone by. The price is showing a bearish engulfing pattern on Friday, which is a sign of relief if follow-on selling comes here. Why do we want the Dixie to fall? Because like all emerging markets, which basically have dollar-denominated debt and import dependency, we want the US dollar to be weak so our local currencies can get stronger and our imported inflation goes down. The price is far above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So while the outlook remains positive, the distance between the price and the moving average tells me that there could be a possibility of a mean reversion. By mean reversion, meaning profit taking and the price easing lower. So if the US dollar index comes down, crude oil comes down, and the USD INR does not rise much, this gives a fighting chance to the domestic equity bulls to take markets a little higher. Falling inflation. Now, this is something that's enthusing the markets a little more. Falling inflation in metal prices, food prices are coming down, wheat, etc. are showing signs of having topped out, at least for now. They are leading people to believe that the Fed may not hike interest rates by a full percentage point or 100 basis points in the future FOMC meet. Now, that is what caused the very aggressive rally in the US markets on Friday. It's expectation A of inflation peaking out and B, future interest rate hikes not being as aggressive as they feared earlier. If interest rate hikes are not as aggressive, the dollar index might fall a little, and to that extent, the Indian markets have a fighting chance of rallying. The weekly chart on your screen of the dollar index tells you that it was a bullish candle, but with a long shadow, which means the bulls did attempt to take the market higher, but higher levels proved unsustainable. Selling pressure stepped in and the index has settled marginally lower. That for India is a good sign. Now, whether follow-on selling comes or not in the coming few days, that will determine the outlook for the emerging market pack. Last week, I advocated a range between 108.65 on the upside and 105.15 on the downside. It was admittedly overcome on the upside because the Dixie tested 109.14. In the coming week, I expect a range between 109.80 on the upside and 106.20 on the downside. Friends, the US dollar index done. I now come to the bank Nifty, which took it on the chin. It lost more than the Nifty 50 itself. In the bargain, losing 1.26% on a week-on-week basis. And it fell on 3 out of 5 trading sessions. Friday's session, as you can see on the daily chart on your screen, holds promise for me. Number one, it showed the bulls fought back from lower levels, and the closing of the day is in the median part of the intraday range. Number two, the price remains above the 25-day exponential moving average, which is a month-long holding on cost of an average bull. So recent buyers are still not losing money and therefore not pressurized to sell out in a hurry. Thirdly, the bearish gap that was left a couple of weeks ago, I've marked it with 2 parallel trend lines. The top of the gap itself is marked as a blue bold trend line, is likely to act as a support on declines. Do remember the old adage in Dow theory, a previous resistance once overcome then turns into support on the downside. It's also a 25-day exponential moving average and it's Friday's low. Now, what we do need to watch is in case the markets fall, do they fall to the lower end of this gap, which is marked as a channel, or not. If the bulls are able to defend the lower end of this channel and a significant swing point, which in my calculation is at 33,757 on the Bank Nifty spot, I think the selling would have been absorbed. On the flip side, if at all I want to see the markets go up sustainably, the first immediate swing high of 35,543 needs to be overcome with high volumes and open interest expansion in futures and options. Coming to the weekly chart, what we are seeing is a harami pattern. A harami pattern in Japanese terminology means where the candle body is contained within the previous larger candle's body. It is the equivalent of the Dow theory's inside pattern. What it tells you was that there was a pause. There was a pause in the previous dominating candle's trend. Here the previous dominating candle is green. Last week's candle is red. So there was a pause in the bullishness, which is why the candle is contained within. Now the prior week's candle, the green color candle low is 33,515. If at all the 33,515 level is violated downwards, the downtrend will begin all over again, and the bulls will have wiped out all gains and initiatives that they have enjoyed in the recent past, and falls will continue. Do note that the 25-week exponential moving average, which is shown as a blue line here, is still sloping downwards. This is a proxy for the holding on cost of a 6-month average bull buying price, and whenever the price comes to that level, there will be overhead supply from trapped traders coming in all the time. We need to overcome this moving average sustainably, and the moving average ideally should trend upwards for a bull market to start, which is what tells me that even though statistically speaking, and I go by statistical data, statistically speaking, the bulls might have gained a little more in terms of initiative and courage, but they still have a lot more work to do before causing a complete trend reversal. In the week before last, this index was number 4 on our in-house statistical beta hierarchy list. It fell one notch to come to number 5, which is good because we don't want a frontline headline index to be very, very volatile. It raises the challenge level for a retail trader. Last week, this index was expected to trade between 36,750 on the upside and 33,500 on the downside, which held in spite of all the volatility. In the coming week, I expect a range between 36,275 on the upside and 33,100 on the downside. I would suggest that you continue to trade light because we still are at a very formative stage of market trends, and volatility is likely to remain elevated. Friends, the Bank Nifty done. I now come to the Nifty 50, which is the most liquid and lowest impact cost traded instrument on the NSE currency, NSE derivative segment. And this index lost less than the Bank Nifty, which makes it an relative outperformer as compared to the Bank Nifty. It fell 1.06% week on week and fell on all 4 out of 5 trading sessions. But Friday's trading pattern will be very, very interesting for a statistical trader. What you are seeing on the daily chart on your screen is that the gap that was left open is marked as a channel. The price went and closed this gap in the prior week. It fell in the week gone by on 4 out of 5 trading sessions, but the fall did not breach the channel low. Number 1. Number 2, the 25-day exponential moving average, which marks approximately 1 month long holding on cost of an average bull, was defended The close on Friday is above that level, which is coinciding with a channel bottom. And in spite of all the selling, the price on Friday has closed with a green candle. Do remember there are 2 holidays ahead of Friday. So what the bulls are trying to tell you is, we don't care whether there is a holiday of 2 days. We are going to take the risk of any bad news and we are going to buy, because we think Monday the markets are going to open higher. Which is why, my friends, I tell you to watch the 75 final minutes of trade on Friday, because this tells you how the market can, I'm using the word can, open on Monday. So now what we need to see is whether this channel, if violated, breaches the previous significant level of 15,858. If not, the bearishness has been absorbed. Professional money has purchased all the stocks that weak hands had to offer, and the markets might just go higher. The previous swing high is at 16,275 levels. If we break out above this level and trade consistently above this on rising open interest and traded volumes, I think the possibility of higher levels cannot be ruled out. So early days yet, but let's keep watching. Frankly speaking, in the week gone by, I see a better statistical position for the bulls as compared to the week before that. So there's optimism in the air. But here again, the death cross on the Bank Nifty and the Nifty has not been negated. You may want to hear me say, okay, there's a bull market coming, but sorry to dampen your spirits. It's still a technical pullback rally. A fairly strong one might come, but then bear market rallies are known to be fairly strong. I've recorded a video for you, which you can watch in the description. The hyperlink is given there. Why bear market rallies are so vicious. So we still remain in a downward market with corrective up moves coming in. Coming to the weekly chart, we are seeing an harami pattern, or the equivalent of a Dow inside pattern. The bullish candle a fortnight ago has been followed by a bearish candle contained within it. There's a pause, and the candle, the fortnight ago bullish candle low is at 15,661 in the spot segment. We need the bulls to defend this level in case the market falls. If they do, that means professionals have absorbed all the selling that weak hands have to offer, panic-struck weak hands have to offer, and chances are another up leg might just continue. Do note that we are still below the 25-week exponential moving average, which is a 6-month holding on cost of a bull. The average itself is sloping down. So number one, we need to go above the previous swing high of 16,275. And secondly, we need to cross this 25-week exponential moving average on a sustained closing basis. The average itself needs to go upwards, and then we can bet on the possibility of the beginning of a bull market. In the week before last, this index was number 13 on the volatility rankings on our in-house metrics. It rose one notch to number 12, which is challenging because a frontline headline index rising higher on the volatility ranking tells you that the challenge for an average retail trader may have gone up. Last week, I advocated an expected range between 16,850 on the upside and 15,600 on the downside, which held perfectly well. In the coming week, I expect a range between 16,650 on the upside and 15,450 on the downside. I would still suggest you trade light because volatility is still remaining elevated here. Friends, one more chart I'll share with you about the appetite of the retail traders. It's something that I've started sharing with you off late. The percentage turnover in the stock options place versus the percentage turnover contributed by the stock futures of the entire MWPL. I told you that when risk appetite is poor, traders may want to go long, but in the relatively cheaper because lower capital involved, options route. When they start raising their exposure in the futures segment, that tells you that these guys are writing out a bigger check and saying, okay, give it to me. I want more risk. Mercifully, week on week last week, we saw the percentage of futures turnover of the entire turnover rise a little bit. Even though options turnover remained high, futures turnover rising tells me that risk appetite is growing. All I want is that this percentage contribution by futures turnover to rise on a week-on-week basis for the coming few weeks with the price, and that would tell me that the two Marshmallow traders are very keen on going long. I now come to the most popular segment of this video, wherein I give you 5 stocks which gain the most amount of impetus on a day-on-day basis, where you take small exposure, wait for large price moves, and 5 stocks that have lost the most amount of impetus on a day-on-day basis, where you take big exposure, wait for small price move. This is for scalpers. Different traders, different mindsets, and therefore different techniques. So high impetus gainers, where you take big exposure, list is led by Aditya Birla Capital, number 2 Idea, number 3 Ashok Leyland, number 4 Aarti Industries, number 5 Ambuja Cements. The impetus losers, where you take big exposure, wait for small price moves, is led by Torrent Pharma, number 2 Shree Cements, number 3 Ultratech Cement, number 4 Whirlpool, and number 5 Honeywell Automation. Friends, I now come to the close of this end of this video, and before I sign off, a humble reminder to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And good, bad or ugly, I welcome your feedback in the comment section. Also, help me reach out to fellow like-minded smart investors like yourself by sharing my video with your friends, your WhatsApp groups, your social media groups, and help me reach out to a wider audience. Thank you for your patience in being with me in this video. I wish you have a very, very profitable week ahead. This is Vijay Bhambwani signing off for now till we meet again in my next. Take care. Bye-bye.